let's talk about the time value of candlesticks. This video is exclusively focused on price action trading and supply and demand trading, and I'm going to talk about something that nobody talks about. It is the time value of candlesticks. It has nothing to do with option time, okay? The time in the option contracts, in the premium that you pay when you talk about time. It has nothing to do with it. It's all about price action and candlesticks. So this video is going to be focused on that, and if you stay until the end of the video, you're going to learn probably a few tips. I'm going to use the popular euro dollar, okay, Forex, one of the most liquid major pairs in the world, in the Forex market, and it is the daily time frame. Well, let me tell you something. I mean, most traders believe that a candlestick is just about four prices: the open, the high, the low, and the close. Okay, so if you take a look at this candlestick here, today is the 19th of August 2025. So this is the high, this is the low, this is the open because it is a bullish candle, and this is the close for now, because the daily candlestick is still open, still a few hours left for the daily candle to close. The Forex market is open 24 hours, so this is still live. On the previous candle, since this is a bearish candle, we have the open, the close, this is the highest point for that candlestick, and this is the lowest point, the low. And we can continue on and on, back and forth, okay, going left to right, talking about all these candlesticks, but a couple of them are enough. But there is, let's say, like a hidden dimension about candlestick. Almost nobody talks about, or I never heard anybody talking about. Well, I don't follow anyone, so that's probably why. But I've been talking about time value for years, okay, since 2013, when I started to do supply and demand more seriously. So this time value of a candlestick is very important, and I'm not talking about options. As I say, it's not the time decay we use when we trade options. I'm talking about, this is the daily chart for the euro dollar, so I'm talking about how long it actually takes, okay, for a candlestick formation to develop. So here we have a candlestick formation made of several candlesticks, 1, 2, and 3, and then suddenly we have a very strong bearish impulse that took 3 days to be accomplished, okay? So when we analyze this, okay, we have multiple candlesticks, 2 bearish engulfing patterns. This is almost a doji, and then price drops. You don't need to give names to candlesticks. It's just that this candle engulfs or consumes, or the candle on the left, and the same happens to this one, okay? And as you can see, it is the strongest impulse on the chart as this one on the left. Okay, so we are talking about for the time it takes for this formation to happen, okay, and how much time price needs to return to the origin of the move, which is actually this bearish impulse, which is also a supply, an imbalance, okay. Not all impulses are imbalances, but all the imbalances are made of impulses. Okay, so, okay, this is an impulse, oh, an imbalance. Nope, it is not. Okay, so this is not an imbalance. This is an imbalance. There are rules for that, but this video is focused on the time value of candlestick formations. This is a price action video tutorial, let's say, that probably will give you some information that will help you take better decisions on Forex trading for short-term, intraday scalping, and long-term swing positions on Forex. And this can be applied to any market, obviously, stocks, cryptos, everything, ETFs. So I'm going to break down using the daily time frame and smaller time frames, the charts where this strong supply level is in control and it's already preparing to react. So, like I said, let's start with the basics. A single candlestick is a picture of a price within a specific unit of time. So we are talking about the daily time frame. So we have one candlestick, another 1, 2, 3, 4, 5 candlestick. This is almost a week, okay? So on the daily chart, one candle represents an entire day of trading, obviously. But when we zoom out, the daily is actually made of 20 hours. So if we go to the, one sec. to the 1 hour time frame. Okay, this candlestick over here, we started, one sec, the day. So that now it's 5:30 p.m. Spanish time, GMT +2 in summertime. So the daily candle started, where did it start more or less? Around here, okay? There, all this is the daily candlestick. So when we zoom out on this case, well, we zoom in and drill it down to smaller time frames, a daily candlestick is made of 24-hour candles, hourly candles in Forex and also in cryptos. But it doesn't happen because they are 24-hour markets. But on stocks, you won't see that, because on stocks in the New York market is usually open for 8 hours. So you're going to see only 8 hours, not 24 candlesticks, as we will see on Forex and cryptocurrencies. Okay? Or if you use the 4-hour time frame, then the daily time frame is going to be made of 6 4-hour candlesticks. Okay? So it would be when this one, but this one started here, I believe. So we have 3 4 candlesticks. We're going to have 6 candlesticks. Okay, so it all depends on that. So when each time frame is independent from bigger time frames or higher time frames and lower time frames. So because price is fractal, whatever price action you see on smaller time frames is going to happen in the bigger time frames. So going back to the daily. Obviously, the daily candle is made of 24 hourly candles, of 6 4-hour candlesticks, and then you can go even deeper to the 50-minute chart, 30-minute charts, 1-minute chart. I mean, it doesn't really matter, okay? But you get what I'm trying to say. So inside every big candlestick, there are multiple stories, because there are multiple time frames lower than the daily time frame. Maybe this is very basics to you because you are an advanced trader. You've been trading for a long time. But this video is also for those who are starting and maybe they are lost, a little bit lost. And most people come to me because they are a little bit lost and they have tried so many strategies and they did not know about supply and demand and how price action creates imbalances. So there are multiple stories, like I said, battles between buyers and sellers. Here there are buyers, but there are also sellers. So which one is going to win? We never know. Obviously, this is a battle of odds, probabilities. But we do know that we have a very strong bearish impulse, which became an imbalance on the daily time frame for the euro-dollar forex major pair at 117. There are reasons why this imbalance was created, but this is for another video. It has to do with the multiple time frame analysis and bigger time frames. And so these battles between buyers and sellers, they are happening all the time, that are compressed into that single daily candlestick here or there or there. So within each candlestick, there is a battle, okay, of buyers and sellers. But when we have a strong supply level in control, usually it is the sellers that win that battle, okay? So I hope that you understand what I'm trying to say. It looks like maybe pretty basic, but most traders ignore this because they are not looking, they just have lots of indicators and oscillators on their chart, red arrows or green arrows, buy, sell, Bollinger Bands, MACDs, and all that kind of stuff, and they will ignore really candlesticks. It's all those signals that you are using with your indicators on the daily, on the 4-hour candle chart, or the 1-hour chart that they will use to take action. They will ignore the basics. And the basics is that the world is governed by supply and demand in every aspect of our lives. And the charts, I mean, trading Forex is not an exception. And then when we look at the charts, when we are traders, we become, let's say, like dummy, okay? We ignore that we are really supply and demand traders in real life. When we buy a house or a car, we always know which is the best price to buy and sell. But when it comes to Forex, cryptocurrency trading, and stocks trading, we just like forget everything about supply and demand that we have, like we were born with it. I mean, in our society, to use supply and demand and every hour, every day. Okay, so now here's where most traders miss the point, because price action is not only about when price goes, okay, like this, or leaves, but also how long it takes to get there. So this is a hidden time value that nobody's talking about. Okay, so okay, the impulse is super strong, crazy. So many traders will say, okay, this is short bias. They're gonna start shorting breakouts. Okay, and then price will reverse because after a very strong bearish impulse or bullish impulse, we are expecting a pullback. So if the pullback is very slow, is that good or is that bad? I will let you think about it. Okay, because I'm going to continue with the video, and at the end, well, I'm gonna be adding some nuggets, okay, of wisdom, hopefully. So the time value of candlestick tells us about momentum. Okay, this is strong momentum. We have bearish impulse, which is stronger than the bullish one. So something is happening. So why did the euro dollar had strong impulse, correction, strong impulses, correction during June 2025, correction, and then strong impulse on at the end of June 2025, beginning of July, 1st of July, and then it drops, and then in the middle, 24th of July, then it drops again. So why is this happening? Okay, there are reasons for that. So when this is happening, when the opposite of what happened for weeks before that, then something's wrong for the bulls for buying in the euro dollar. Okay. Sorry. So most traders miss this. It's not about like when price leaves or takes off or breaks out, but also how it approaches the origin of that move. So the time value of a candlestick tells us about the momentum. I said the urgency and the strength of the institutional orders behind these moves. So obviously if I tell you something now will be so obvious. It's like strong impulse. Which is stronger, this one or this one? You will obviously say this one. Okay, so then why many traders will buy into this? Because they are ignoring these in obviously the daily time frame. And if we talk about the weekly or the monthly, well, they are like science fiction time frame charts for them. Okay, it's too high. So they will usually use the 1 hour and all that, and then they will not know when you look at the 1 hour time frame, this blue rectangle here contains the whole daily imbalance drawn on the daily time frame. So as you can see, it's impulse, strong impulse, strong impulse, strong impulse, and suddenly we have like it reversed. Why? If you're not looking at the bigger picture, you don't know why. And the why is that the daily supply level gained control. That's as simple as that. But if you are not watching these time frames, the bigger ones, then obviously you're going to be buying into them, and you will be unaware that we have a daily in a downtrend and the supply level has taken control. Okay, so the thing now is that candlesticks don't go alone. I mean, they merge together using multiple candlesticks, okay, formations, patterns. There are many books out there that talk about it. I will create a price action course soon, hopefully, to talk about many of these patterns in a different way, using supply and demand, how we can use those patterns with supply and demand. So think about strong bullish impulse, like this one over here. Okay? So if it takes like 1, 2, 3, 4, 5, 6, 7 candles to rally, okay? It takes 7 candles to rally. Or this one, it takes 3 candles to drop, okay? To rally, let's say, I don't know how many pips, but it's like a lot of pips. But let's say, for the sake of simplicity, it's like, I don't know, 300 pips. It rallies, in 7 candlesticks, it rallies to 200 pips, okay? That is a very different story than if it takes 15 candles or 20 candles to rally this same distance. So which one is better or stronger in your opinion? A rally made of 7 candlesticks, okay, or a rally made of 15 candlesticks? Which one is stronger? Obviously, the one that is made of less candlesticks. Like in this case, it takes 3 candlesticks, in this case 3 days, because we are watching or looking at the daily time frame, and then it takes 1, 2, 3, how many candlesticks? It takes 9 bars, 9 candlesticks. So it is 9 days versus, okay, 3 days. So which one wins? It wins the 3. Obviously, it's stronger. It takes less time to make this move, okay, which is like 3.24%, 391 pips, I think. I'm not using the pips as a measure for Forex because I'm using percentages instead. So, but obviously these 350 pips took 3 days. Okay, this movement took 3 days to make the move, and then 9 days to go back to the level. So obviously the time value is being ignored by most people, obviously, because it is very important. They're being ignored because, well, they are not being taught how to use it. Okay, so supply and demand together with time value and how fast it arrives, the basing structure and everything. Many ways of, well, just a few ways of describing an imbalance, of scoring an imbalance, of grading an imbalance. And the strength obviously is one of the most important ones. The speed, the time compression on the way up, okay, tells you how aggressive demand or supply was at the moment. Okay, so this is a great setup for selling the euro dollar because we have a very strong supply level that took only 3 days, and then the slow approach towards the supply level on the daily for the Forex, the euro dollar. It took 9, so 9 loses over 3 days. Okay, so the same principle applies when price comes back to retest. Like I said, the same principle. So if it is slow, is it going to be better? If it is very fast, is it going to be better or not? So when price comes back to retest that imbalance, if it takes weeks to retrace to that supply level, that pullback carries a completely different meaning than if it takes only 1, 2, 3 days. Okay, if price snaps back like this, very quick, in a candlestick or 2 candlestick, in this case 1 or 2 days, in 2 sessions or a couple of sessions, then it's not a good idea. Time adds value or takes it away. So a slow grind back into the supply level that we have on the euro dollar daily time frame usually means that fresh orders are building up, while a fast return may weaken the level's probability to hold. So what happens here is that if we put this theory into practice with the euro dollar, as we've been discussing here, on the daily chart right now, the current price for the euro US dollar today, the 19th of August 2025, is 170, well, 160, say 116, more or less. And there's a daily supply level, very strong. Price took 9 days to retrace. We can see bearish price action over there. Now it's a doji. Today's candle, the 19th of August, is a doji. So there's indecision. It could go up or down. The path of least resistance is down because we have a strong supply level and the daily is trending down. So price has started to react to the zone with a clear bearish impulse. If these lows are broken, the euro dollar is going to drop much lower, and if this latest impulse, which is weak, is broken, then the euro dollar is going to drop much farther. So like I said, you should notice how long it took for the euro dollar market to climb back into this supply level, and it wasn't 1 or 2 candlesticks. There were 9 candlesticks on the euro dollar forex cross pair to climb back to that level, whereas it took 3 to drop strongly. So it was a structured, time-consuming, time value is what we're talking about here, pullback that is stretched over 9 sessions or 9 days. So that tells us something very important, that the market needed time to accumulate liquidity for the big players to fill their orders. But what happens? That now price touches the euro dollar supply level at 117, over there, and we start to see the reaction as we expect, because it is where everything started like a couple of weeks ago, the 28th of July, the end of July 2025. This strong impulse happened. So the market needed that time to accumulate liquidity, okay, like I said. And now price touched that daily supply level. The reaction we are seeing is not random. This is not random. This is not magic, okay? The reaction we are seeing is not random, like I said. It is the direct response to this imbalance on the euro dollar, time with patience. Because if I tell you, if you know that the euro dollar has a short bias, but I tell you, well, you're going to have to wait a few days. Oh no, I want to take a trade on the euro dollar. What do? You probably buy. But then if you do a breakout trading above these highs, then you lose because price drops below those with this candlestick. I mean, there are many ways to trade, okay? Obviously, supply and demand is just one of many Forex trading strategies to trade, in this case, a swing position on Forex, but you can use it to trade intraday and short-term scalping the Forex market, okay? So the thing is, the art of trading, the art of waiting, sorry. Here's the reason trading is about patience, because most traders get hypnotized by the smaller time frames. They go to the 1 hour and they start to see like, okay, low, high, high. They will use the Bollinger Bands, MACD, CCI, RSI, whatever, okay? But they don't take a look at the bigger picture, like on the daily, like I said. They look at patterns like engulfing patterns, dojis, piercing patterns, pin candles, pin bars, some could call them pin bars too, and they forget to ask the most important question: how much time did the euro dollar Forex cross pair took to drop, and how much time did it take to rally? So if you put that into a balance, then you will get some really nice answers, okay? And this video is talking about that. So the longer and the cleaner the build up is, the more meaningful the imbalance becomes, okay? In this case, this is an imbalance. Remember, this is not an imbalance. This was an imbalance that was eliminated. This is not an imbalance. We're talking about imbalances, okay? So when you combine that with strong supply and demand levels, you get the type of setups like this one on the daily, or many others that I have described and analyzed for stocks, forex, and cryptos on my YouTube channel and Center Online Training Academy and community. So this is you get this type of setups where professional traders place their orders, not retail gamblers chasing green and red candles using indicators and oscillators. So the next time you look at the chart, don't just use it to see a single candlestick or a formation of candlesticks as full prices, okay? The high, the low, open and close. See it as a story, or let's say a story of time, of patience and of order flow together with supply and demand. And remember as well that the time value of a candlestick might be the missing price or action piece in your price action strategy, okay? Could be that the missing puzzle, that you are maybe ignoring the fact that the speed of arrival, the speed of the breakout is also very important. And also it is as important the way or how long it takes to build up and climb up to the origin of that move. So right now the euro dollar is giving us the story on the daily chart with supply and control, as I said. So be patient, let the reaction play out, and don't force trades, and don't chase trades. So if you are short in this position, you should be managing the position. This position was shared a few days ago on Set and Forget Online Trading Community. And if you enjoyed this perspective of price action, supply and demand, and candlestick analysis, hit the like button on my video, subscribe for more supply and demand videos, and drop a comment. I will be glad to answer your questions. Have a great day.